Hi guys, welcome to SavvyMoneyShow. Me, your host Sean. Today we're carrying on with the value ETF. This is going to be more income statement, free cash flow, and the like orientated. Anyway, we're going to start with Berkshire B. It's got a trailing P of 7.7. Price to sales 1.91, price to book of 1.36. Everyone goes on about the cash they have on hand losing value, but no one says about how the majority of the shares they have are effectively free because of the dividends that are paid out. And we have Walgreens Boots Alliance. This is where finance makes up a bit. It has a 3.5% dividend, but it's got on its opening page it's a 7 PE, and you go to statistics, it's a 21 half PE. Anyway, it's a forward PE of 10, price to sales of 0.3, price to book of 1.83. The thing about these is because of the COVID vaccine, now have a massive amount of data, and data is like the new oil. Don't forget to hit that lovely like button. And don't forget the sexy subscribe button, a lot sexier than me, just ask the wife. And if you want to be a hero, hit the bell notification. You'll be notified when a new video gets uploaded. And why not check out the links in the description below. If you're looking for a free trading platform, you get a free share worth up to $200, depending on the platform you use if you deposit a small amount. Right, and we have VICI, 5% dividend, P of 15, and has a forward P of 13, price to book 1.4, price to sales of 10. Price to sales is a bit higher, but we go to Flagstart Bancorp, P ratio of 4.6, and dividend is 0.47, so hardly worth worrying about, but still it's a dividend. Price to sales 1.6, price to book 0.6. 0.96. We have FLIC, which is P ratio of 12, a dividend of 3.5%. And remember, these dividends are not guaranteed. It gives a price to book of 1.21. You have Flex with a 14% dividend, market cap under half enterprise value, trailing PE 9.6, forward PE of 7, price to book of 1.3. Falcon Minerals got forward PE of 13, price to book of 1.66, and we have 2.57% dividend and a 10 PE for Aflac, ticker symbol AFL, and we see price to book of 1.14, price to sales of 1.76, and we go to FLWS, which is a 14 PE, and you'll see it's a 12.4 PE, forward PE, price to sales 0.73. Foot Locker with a 2.85% dividend, it goes ex soon. Market cap 2 billion below enterprise value, trailing PE of 5, and forward PE of 6.8, and price to sales 0.53, price to book 1.33. FLGT, I've done a video and pod on this, and it's got a P ratio of 4, and the forward P is because they think that COVID testing will be finished. I don't think it will. Even if it is, for a genetic testing company, this isn't bad metrics, still profitable. Tencent Holdings. Now this isn't saying you should go and buy it. This is only saying whether they come up as value or not. Market cap below the enterprise value, trailing P under 20, and we have Nestle. Now it has 2.2% dividend, but the thing about it, the price to sales and price to book put it out of my margin for the ETF. So I think this is one which technically should be in, but isn't because of price to sales and price to book. And we have Qualcomm with 1.5% dividend, has a forward P of 17. It has price to sales and price to book really high, but they are signing contracts, quite lucrative contracts. I expect that to come down. You have Disney, which, as you can see, the P ratio is high, but its market cap below enterprise value. The forward P is 33. You can see that being slashed, and I think the price to sales, price to book will as well. And you'll see with Google that has a P of 26, and you'll see that even though price to sales and price to book of 8, you'll see that coming down because they've been spending so much on R&D. So United Health Group, UNH, with a 1.26% dividend, 1.65 price to sales, and of course we then go to typical value stocks like J&J, which have a 2.44% dividend, but although it has a forward P of 16, its price to sales 5, price to book 6, and it's falling out of value territory, especially with all its legal problems and the fact it has to split up its business to survive the legal challenges. You have, of course, L'Oreal as well, with 1% dividend, but it has huge free cash flow like J&J, but all its other metrics push it out of my ETF. Now, we have Cisco, which is 2.4% dividend and forward P of 17, and we are moving. AbbVie has a 4% dividend, forward P of 9, and we have Reliance Industries, which has minimal dividend, forward P of 23, but huge free cash flow. But again, because of its other metrics, it won't make it in my ETF, I'm afraid. Walmart, which is 1.5% dividend and forward P of 21, price to sales 0.7, its market cap under enterprise value is just such a Goliath. Whether there's a recession or not a recession, it's also going to be spinning off Flipkart. It's one of the highly anticipated IPOs this year. It will make it in. Novartis, a 3.5% dividend, biotech, with a forward PE of 12, market cap 180 billion against an enterprise value of 206 billion. And of course, we go to Intel, who are going to be spinning off Mobileye this year, 2.6% dividend, and it has a P of 10, forward P of 14, and as you can see, there's not going to be much. I don't think there's going to be much growth there once they spin off Mobileye. We then move to Bank of America, 1.7% dividend, 15 PE, and forward PE of 14, price to book of 1.46. We of course have Pfizer, 2.87%, dividend, 15 PE, and 11 forward PE. If you found any of my videos helpful and you want to help me make more, you can support me by buying me a coffee. The link is in the description below.